Jim, Brent, welcome to the EM Unlocked podcast. Thank you very much for coming. This is the first time we've had two guests at the same time, which is unique. I want to start off, as we always do, with a little bit of a bio for both of you. I'll brief it because there's two of you, and then we'll just start off with the first question. So, again, thanks again, Jim and Brent, for coming. You are both the pioneers of and founders of Lucerna Global Capital, which is an alternative investment manager with both, I believe, directional and also hedge strategies, but really 100% focused on EM. Brent, you're the MD and head of research. Prior to joining Jim at Lucerna, obviously you overlapped at Fidelity. You were a PM for the Latin Fund, which we discussed a little bit from 1998 2010. Then you were with Manulife on the EM Fixed Income Fund prior to obviously joining Jim Lucerna. Jim, I've known you a long time. You are the founder, CIO, and PM for Lucerna Global. Prior to that, I think everyone knows you for your many years, 14 years at Fidelity, where obviously you overlap with Brent, work with him. You were the EM PM for the Fidelity Emerging Markets Fund, which I think at its peak was close to 40 billion, which is astounding. Prior to, basically the performance was spectacular prior to leaving. I think you were number one in the 1 in 5 year performance with that kind of AUM as of December 2020. Outperforming the benchmark by, I think, an average of 200 basis points per annum. And then you had hedge fund experience. You worked for 2 Tiger Cubs. You also lived in Mexico with Morgan Stanley. I know you lived in Brazil for some unknown asset management company, and you've kind of traveled the world. I think you speak 5 or 6 languages. I'm not sure. But anyway, thanks again. And so let's start off with just a basic question. Talk a little bit about why you founded Lucerna after Fidelity and what you and Brent think. Because as we discussed a little briefly before you came on, emerging markets has been completely out of favor for a very long time. So what drove you to start Lucerna and really sort of get into something that really nobody wants to put money in right now? But hopefully that'll change soon. But anyway, sorry, Jim, go ahead.
No, that's great. That's great. Well, first of all, thank you both for having us on. I've known you both for a long time, and always really enjoyed the dialogue, and so it's a real pleasure for us. So thank you. Look, I think in terms of thank you as well for your kind words as to our backgrounds. The fund I was on at Fidelity, to be clear, was a co-managed fund, and I had a talented group of co-PMs that helped drive the performance as well. I think there were 2 insights that led to the desire to have a different platform. One was, a $35 billion vehicle, mostly in mega caps, 364 names, might not be the best mousetrap for investing in the asset class. We wanted a vehicle that could be more nimble, could be more concentrated. And that's really what Lucerna is trying to be. And then the second reason was that we thought, and we were a little early, but we think with even greater conviction now, that emerging markets were poised to have a much better secular window of performance. After 15 years of a bear market, things have gotten cheap, things have gotten overlooked, and we see lots of opportunity. We see lots of, we look for compounders, we look for multi-baggers, and we see potential multi-baggers everywhere, which I think is much harder to say about developed market peers.
Are you finding a lot of interest from investors at this time? Is that part of it changed?
I think the interest has picked up a lot. The pipeline, the conversations, the flows themselves have also picked up, but I think that's a more gradual process. Investment committees meet at the end of the year and they think about how they want to be positioned for the next year or two, and I think those processes and conversations are happening now. So hopefully that kicks over into the new year.
And obviously, we would think, given a solid year where finally outperformed developed markets, that hopefully helps to turbocharge some of those conversations and reassessments.
So it's amazing. Emerging markets in general have done very poorly. Interest has been down so much, and new capital has been so difficult to find. But emerging market value is even worse, right? Emerging market value, they've all disappeared. There's, that was as I was saying earlier, we had at AllianceBernstein, we had about 30 billion in emerging market value. You know, I was like, I mean, you can't even imagine how you would invest that today. But that asset class has completely disappeared, right? And you're really like, there are not that many people doing what you're doing, right? It's pretty exceptional. It's a great sign, and I think it's fantastic.
Well, look, thank you for saying so. And we do have a bit of a value bent. We're not deep value, replacement value, trailing earnings only. We like to find great franchises that can grow at a reasonable valuation. So that's kind of our sweet spot. But to date, this year, the rally has largely been driven by tech and growth and a handful of names in Korea and Taiwan. And part of the reason we're excited about the forward roadmap is that we think that broadens out. And we see lots of great consumer, financial, other companies across the emerging markets footprint in Latin America, Southeast Asia, otherwise, that are really cheap and have nice, predictable forward growth roadmaps. And that gets us excited.
What do you think has changed in the global macro environment that's bringing emerging markets back? I mean, the past 15 years has been a period of quite remarkable American exceptionalism, where just America was everything.
Yeah.
Is that change? You see that as a pivot here, that we're going into a period maybe of American malaise where capital is flowing out of the U.S.?
So I would say two things. First, if you look back over the 75-year history of global equity markets, because they were pretty narrow before that, these things tend to work in cycles. And the U.S. typically, and the dollar outperforms for a 7 to 10 year cycle, and then it reverses, and emerging and international markets outperform for 7 to 10 year cycle. So this cycle, the 15 years that you correctly refer to, is the longest cycle of U.S. dollar outperformance and emerging market underperformance in that history. There was one that was more dramatic into 82 with Nixon and the gold standard in Mexico blowing up, but this is the longest. And we think that it's not different this time. We think that there's going to be a reversion to the mean. We think that the dollar's gotten expensive. Other places have gotten cheap. Their currencies, therefore, lead to better export growth and better economic growth, which leads to multiple expansion and better earnings growth at the company level. And so, we think we're in the process of that virtuous cycle beginning after what has been a long, vicious cycle.
Part of your thesis is a weak dollar. Sorry, go ahead.
Well, I said there were 2 points. So that's one. We think that the cycle, we're at the trough of the cycle for emerging markets and at the peak for the dollar, near the peak for the dollar and U.S. assets. But the other point is, part of what used to drive U.S. exceptionalism is no longer as exceptional. The U.S. now runs its fiscal policy like an emerging market historically has done. And the risks, frankly, if you don't give the U.S. dollar the benefit of the doubt as a reserve currency and the U.S. market the same, if you look at the U.S. through an emerging market lens, it looks vulnerable.
Is a key part of your thesis a weak dollar then for an extended period of time?
It's our belief, but it's not what we do. We're not a macro fund. We're a bottoms up stock picking fund. Brent and I were both at Fidelity for 12 and 14 years, and we're stock and sector analysts. So we try to find, I described it briefly before, but we try to find good companies with good growth roadmaps at a displaced valuation that we can buy right and let them compound over a long period of time. It helps us if the currencies are a tailwind, not a headwind, but it's not core to what we do.
Jim, you were one of the, I guess, first to really identify some countries, for example, like South Africa. I mean, it was interesting when it was almost 2 years ago when you first started posting about it. So in this global macro, I know you're not a global macro, but in this context, and we'll start going around the horn. What was happening in South Africa, either from a company standpoint or that you thought it, because that was pure contrarian view at that time when you posted how you thought South Africa was good value. So what did you see? What was, and that we can start there from go with other countries, but
yeah. Well, so what, you did a nice portrayal of my background, but one chapter that you brushed over was I was fortunate to be living in South Africa with Bain under Mandela in the late 90s. and Turkey and a handful of other markets with Bain. And so I was there on the ground, and it's a wonderful place. It's a wonderful country. But I think two things. One is it's a really interesting moment. People have been worried about the politics in South Africa for a long period of time, and I think rightly there are risks longer term in terms of how things swing. But right now is an interesting moment. They're actually tilting in the right direction. You have a partnership between the ANC and the DA. The DA is a more conservative party that's done a good job managing at the state and city level, and they're getting stuff done. They're more efficiently managing it for the first time in a long time, which is really helpful. And then the second thing is kind of what I referred to before, that this year tech has worked, but there are these countries where you have really good businesses in the consumer and financial sectors that are really cheap, and that's what got us. That's what got us intrigued with South Africa a couple of years back. It's been a nice market for us.
What are some of the other markets where you're finding a lot of really attractive opportunities?
So we love Latin America. We have a bit of a fond spot for the region from a personal background perspective. Brent having run the largest fund in Latin America, and myself having helped to open the office for Morgan Stanley in Mexico, and having lived and worked in Brazil for a fund as well. But we think that, again, we're very much bottoms up, but top down matters. You can't divorce yourself from the top down in emerging markets. And there is this shift after years of poor governance and non-business friendly environments towards the center. And it's, it started with Argentina a couple of years back. It's just happened with Chile. We think it happens with Colombia in the spring. And then the big wild card that could go either way. We think it goes the right way, but it could go either way is Brazil next fall. So we like the region from that perspective. We think there's a structural shift happening. And again, we find lots of great businesses at good prices we think can compound for a long period of time. We like Southeast Asia a lot. It's been a laggard this year. Indonesia, the Philippines, same kind of thing. Big markets, big growth road, good growth opportunities looking forward over a long period of time, and some great businesses that trade at really attractive valuations. So those are two that I would highlight. In India, there's less value, but we like the banks a lot. We do find particular value in the financial services and the private sector banks there. So that's another region that we like. And then EMEA, the Middle East, Africa, Eastern Europe bucket is much more bottoms up. There are a couple of businesses we really like, but there's no market top down where we are as excited as we are about some of the ones that I mentioned.
Hey, Brent, let me get you in the mix here. So for Latin America, per se, when you look at companies, whether it's in Argentina, Mexico, or Brazil, and you guys are saying, let's say, okay, from a top down, we want to get involved, let's say in Mexico, and you're the one obviously doing all the models. I mean, again, given all the volatility we've had, what are you looking for to find a good business to invest in when you're drilling down the numbers?
Yeah, people forget this. From 2002, when Lula came in the first time, Brazil went up 7 times in dollar terms in 5 years. It was really dramatic. Now it's gone down ever since, literally. But it's as cheap as it was. It's on 7 times earnings, and it's on a 7.5% dividend yield. Like, if things go the right way from a policy perspective, there's a lot of value there.
Yeah, well, I agree. Bradesco is one of my favorite stocks as well, so I'm very happy you like it. But there is a lot of disruption going on in Brazil. If you look at the retailers, like Lojas Renner, which was a huge darling, they're just getting crushed by the competition from the online retailers. And in the banks, you now have Mercado Libre, you have Nubank. Some people believe there's a fundamental change in the competitive environment in Brazil. And of course, I worry about that because I have the same thought you have, is that the disconnection between Bradesco and Itaú doesn't make any sense. Eventually, at least in the past, they tend to trade in a pretty similar fashion. But if there is some kind of real change in the structure of the market, then that would be a problem. What are your thoughts on that?
Well, so, the interesting thing, for better or worse, particularly in Mexico, is obviously the roster of companies hasn't really changed in the 25 years that I've been doing this, right? So, and the players that were the strong operators have largely tended to remain the strong operators, whether it's, Banorte is one of the banks, or BBVA obviously isn't locally public, although you could play it through Spain, for instance. Or Walmex has had a bit of a tough sled here of late with competitive landscape shifting to some degree. But the companies that have been the strong players have sort of been the strong players for a long period of time, and so to some degree it becomes a little bit of a cyclical investing scenario, right? Where if I'll shift away from Mexico for a moment and think about Bradesco and Itaú, as the pair of the two banks, and usually you can sort of reliably know that if Itaú has run up into the high twos on a price to book basis, then and if Bradesco is trailing behind, then it's probably about time to rotate into Bradesco. And if you think about some of the various moments of folly over the past 10 years in Brazil where, Itaú got beaten down, a conversation that we were having earlier this week is often the banks are among the best operated companies in any of the countries and have managed to survive many, many crises. Then when those valuations get beaten down, it's a good time to cycle back in. And to maybe pivot back to a topic that Jim alluded to, particularly with Brazil, with real rates at the level they are, the benchmark rate is at 15%, making real rates low double digits. The currency is probably weak relative to where it should be if there wasn't sort of this looming specter of Brazil. That's a combination that looks a fair amount like the mid 2000s, where you had rates come down, you had the currency strengthen, and you had the market revalue as well, right? And over that period of time, Brazil was up, what is it, Jim, 7x the Brazil or 5x?
I would say there's a lot of change happening everywhere, right? We live in a period of rapid innovation, and that's affecting a lot of industries, including consumer and financials, as you rightly refer to. And I mentioned before, we are valuation sensitive, but we're not deep value investors in such a way that we're only looking at the Bradescos and kind of wounded franchises of the world. Our biggest position in Brazil over time has been Banco Inter, which we bought because we looked at Nubank, we looked at the valuation it got, 70 billion market cap, 6 times forward book, good business, growing at 25, 30%. Inter was growing the same, is growing the same, 25 to 30%, but was trading at 1 times book when we bought it or less. And they are, because of operating leverage, are growing the bottom line and the ROE faster. There are only 2 digital banks that are listed in Brazil. And it's been a nice performer for us. We think it could be a 10 bagger from here over time. It's still a 2.5 billion market cap, and it's got secured lending as opposed to unsecured lending, which Nubank has. So we think it's actually, you both have less risk and more reward. So that's a microcosm of the kind of thing we look for.
What are the sectors, the other sectors that you like in Brazil? What are areas you think can grow significantly?
So financials has been an area we've been involved, consumer and utilities is a little bit unique to Brazil. We don't do a ton of utilities outside of Brazil. Brazil has a very diverse and dispersed utility sectors. We've had some sanitation and waste management exposure, and we've also had some traditional utility exposure there.
And importantly, on the basis of the privatizations, right? So you've seen Eletrobras privatized, you've seen Sabesp privatized, Copel. Obviously, Copasa, just I think yesterday, sort of finally got the finalized votes to move forward with that privatization. Which, if memory serves, really is the last time you had relevant privatization in Brazil from a utility space since, I guess, Telebras, right? So which would have been mid to late 90s. And you look at Copel and Sabesp and Electrobras was a slightly different animal, obviously, given the fact that it was a little controversial with respect to the privatization. And in the early days of the Lula administration, there was some concern as to exactly how things might happen there. But once you sort of shook off those anxieties, I think Electrobras has been up near to 90% this year. Those are not obviously the type of returns you typically would see with a utility company, right? So, and just a ton of efficiencies to be wrung out, and so it makes for a slightly more compelling opportunity set than typically what you would envision with utilities in other parts of the world.
It's interesting that Lula, in the end, he didn't do anything about Electrobras, right? He accepted it.
Well, and I have a personal opinion on this, and given your time in Brazil, I'd be curious to hear your perspective as well, because I think they were very savvy when they made the decision of who to bring in as the new CEO, given his period of time at Petrobras, and sort of the way that he has navigated, and he was at Banco do Brasil prior to that, right? So Ivan was always a capable, sensible practitioner within sort of the PT infrastructure, and I think having him there helped probably cool some of the the eyes that were looking askance at the decision to privatize a big champion.
Honestly, I never thought Electrobras would ever get privatized. It was such
and now imagine what might happen.
Important to the politicians. So that was one of the great developments in the Bolsonaro years. But Lula hasn't done anything, and I'm just wondering: is the Brazil investment case is it based to a significant degree on Lula losing the election, or is that irrelevant?
It's a good question, and if you ask a spectrum of people that invest in Latin America, you'll get different answers. I would say the following. Lula's Lula, it's not the PT. In other words, once he's gone, I think that they lose a lot of their sway. So the good thing is, even if he wins, this is the last time he can win. And then the PT is probably done for a while. If he wins, the next couple of years are going to be tough in Brazil because the markets don't trust him. You can, whatever your politics are, whether you like him or don't like him, the markets don't. And so the rates will stay higher for longer. The currency will weaken. The investment climate will be difficult. The market won't do well. If he loses, and we think he does, it'll be the best performing large market in the world for 3 years in a row.
Yeah. Yeah. So, yeah, that makes sense. Yeah. Argentina, you continue very bullish. You think Milei can continue with his considerable success?
We do like Argentina. They have, like a lot of the region, they have a way of making things more dramatic than they need to be, including this last wobble around his ratings into the midterms. But look, he's doing the right thing. He has regained popularity. He's got a decent shot of coming back. If he comes back in a couple of years' time, we think Argentina can right the ship. They have a wonderful set of assets from a mining perspective, from an energy perspective, rare earths, geopolitical. Argentina off a low base could be a nice grower for a long period of time. And again, there are businesses there with a lot of value. The banks are tiny. The banks are 2-3 billion market caps for a country with 40 million people, and mortgage penetration to GDP is 3 or 4%. Which is fractions of what it is across the developed world. So off a low base, if Argentina gets it right, they can grow for a long time.
So when you buy a stock in Argentina, are you assuming this kind of high growth, or they're cheap as it is?
They're cheap as it is. They're cheap as it is. We own one bank, we own one energy company, and we own one real estate company, and they all are cheap on every metric, whether it's earnings, whether it's free cash flow, whether it's price to book. Again, the risk, unless things go dramatically wrong, and we've got at least a couple of years for that to happen in terms of the next electoral cycle. The risks are reasonably low, and the upside is reasonably high.
Chile, is Chile investable, or is it too illiquid, or nobody seems interested in Chile?
We love it. That's one of the few markets where we love it top down and we struggle bottoms up. It's been hard to find individual vehicles that get us excited there, but we like the market. There was a lot of value there. There still is value there. The banks are kind of expensive there. and the penetration of most financial products is higher. So we're not as excited about the banks. Some of the consumer names have had a nice run, and we don't see as much value there. So we do find ways to play it, but it's one of the few markets where we do like it more top down than we do bottoms up, and we find better bottoms up opportunities elsewhere.
Is that the same, for example, in Colombia as well?
Colombia, so we love Bancolombia, and we've owned that for a while. So it's easier there. We had an example there, bottoms up, where we saw a lot of value and we saw a good way to play it. So with that exception, I would say it's similar, but it's not as deep of a market in terms of the opportunity set.
So this consolidation of the three countries into one market could actually be a positive. The Chile, Colombia, and Peru merger into what they call NUAM, which was supposed to start next year, but I don't know. But eventually, when that could be a good thing by combining and instead of having everything separate. I don't know. What's your thoughts on that?
No, I think so. Look, liquidity matters. And if we're right on the asset class, then liquidity will come back to emerging markets, including some of these smaller countries. But to have a platform which gives more visibility and more liquidity can only help.
In your mind, Jim, what's it going to take for the IPO market just to start up again, especially in Brazil? I don't think there's been an IPO in Mexico other than Aero Mexico for like 5 years. I mean, it's just been a real drought, which obviously hurts liquidity. What do you think it's going to take? Is it going to take more investors, or is it going to take, the markets itself to just try and see what happens?
We probably have, Jim and I probably have slightly different points of view on this. I think, and actually we just took a meeting earlier this week on a Brazilian utility that is doing sort of the fishing trips right now to feel out. In this case, I think they're big enough. It is a sanitation related, so they're sort of leaning into the universalization that is what has people excited about Sodexo and Copasa as well. They and the bankers seemed a little unsure as to whether really to try, sort of pre-election or not. This particular name, they made a reasonably compelling argument that they thought, sort of irrespective of whether Lula won or not, that the universalization theme would continue to move forward, and that their business prospects would remain the same. I think so. So I bring it up because it's one of the few names that we've heard of late where I think their rationale kind of resonates with me. If they bring the deal, in March and then Lula wins, they're gonna have a tough outing when they first come out, and probably will be proved to be right that the business is resilient enough, and that even a PT government wants to see the continued connection of people to sanitation systems, right? Bigger picture though, I have a hard time envisioning the IPO market really meaningfully heating up until there is resolution. And maybe there's a handful of other examples like this utility that have kind of a unique offering that maybe could still thread the needle, even if Lula's polling strongly in April or May. But short of that, I think you really are going to need to get through the election. Alternatively, if whoever it may be, if it's Tarcísio or one of the other candidates, if they begin to build momentum and the market feels like things are heading in the right way, then I think it would be pretty easy for there to be a far more effervescent IPO market than what we've seen for a while.
Any exciting opportunities in Mexico?
Yes, is the short answer. But I might not give too many details because we find there are a couple of small to mid cap consumer names that we really like there that I don't think I'm going to expound on which ones for a variety of reasons, but we do see value there, and we think Mexico is a winner long term. Right now, it's a bit in a holding pattern because people are waiting to see what happens with USMCA and the NAFTA renegotiation. And unlike the other large countries in the region, you don't have this shift that people are getting excited about from a political perspective. But their economy is tied to the U.S. They are taking market share from what was the China axis in terms of manufacturing and industrial, infrastructure and linkages, and that's sustainable. That's real. They're going to be part of our economic orbit more and more going forward, and that's going to benefit the country.
They should be a big winner from reshoring.
Correct.
Yeah.
What's your view in Mexico specifically about this? I mean, are they from corporate governance? I don't find them very shareholder friendly, to say, trying to be kind, investor relations, this type of thing. I mean, what's your thoughts on Mexico and corporate governance in general?
Gosh, Brent might have a different answer than me. I lived there during the crisis and helped establish a banking office there. It's a market that I know well and I love. It's a wonderful country. I think that the quality of investor relations and communication there is actually pretty okay, at least in the context of the emerging markets footprint. Not even LATAM, but across emerging markets. There's pretty good access, pretty open, willing to talk about strategies and forward outlook and whatnot. Are there governance risks? Of course, everywhere, emerging markets, U.S. But I think it's a very important focus for us. So we're very, we're bottoms up. We're very risk focused. Before a name goes into the portfolio, we have a detailed checklist that really focuses on the risks, and governance is a huge one. Usually, not always, but where there's smoke, there's fire. When a management team has a bad reputation, whether in Mexico or elsewhere, there's usually a reason for it. And occasionally it can be misplaced, but often it's a red flag that's worth paying attention to. But we try to dig in and really understand that type of situation.
How do you find shorting opportunities in these markets? From a liquidity point of view and a transaction point of view.
I mean, the way we describe it. And a lot of you guys and a lot of the people on this webcast might be aware of this, but the U.S. market has shrunk a lot in terms of the number of names that are listed over time, right? Whether it's private equity, whether it's M&A, whether it's companies waiting longer to go public, whatever it is. So I might get the numbers slightly wrong, but I think it's 4,500 names are listed in the U.S. and there's 9,000 listed in emerging markets. So there's twice as many names. And the U.S. is 65% of global equity market cap, and EM is 12. So, there's a lot more dispersion, right? There are always countries, sectors, companies where things are getting better, where things are getting worse. So that's one of the things we like about the asset class from a long, short perspective. And we know our particular sectors, we think as well as anyone, which allows us to identify interesting situations, inflection points, otherwise, and to capitalize that on both the long and the short side.
Execution point of view, it's not difficult in terms of transaction costs and.
It can be. We have a single prime broker, JP Morgan, and they're they have decent access across markets, so they've been a good partner in that regard. There are some markets where it has to be on swap as opposed to on cash, and that adds some operational complexity and cost, but that's fine. The liquidity is okay. I mean, there's some markets where it's more of an issue than others. There are some markets where there are quirks, Vietnam, where you have to. To buy anything that's interesting, you have to pay a 15% premium, and then you suffer that loss day one of trading. So there are some quirks like that on both the long and the short side. But liquidity on the short side, we found generally okay.
Do you operate fully hedged?
So we have the two different vehicles or strategies. We have a concentrated long-only strategy, which we've been piloting, and we're going to be launching into March, which is ex-China, and we can talk about that. And that's 15 to 25 names. And then we have a low net hedged strategy, which tends to be sort of plus or minus 20% net exposure. And again, it's all bottoms up. It's all idiosyncratic, company specific. But that's a vehicle where we express that kind of view.
We haven't talked about China, obviously the big market. What is your view? I can tell you, I've been out of China for 4 years, and I haven't been so far motivated to get back in. What's your thinking on China?
So we have a view. We have a pretty firm view. It's controversial. I think there's a big portion of the emerging market investor base that really likes China, and they view it as innovative and where you can find some great growth stories and innovation. We take the other side of that. We think that China is going to be a difficult market for a number of reasons. One of those reasons is, I was a little infamous at Fidelity for claiming as early as 2015, 16 that the entire property sector was going to go to zero, which it essentially has. The property bubble that they had was so extreme, and so much of the wealth, they haven't had a proper equity market, which we'll get to, as in terms of a savings and investment vehicle for decades. And so people have instead stored their wealth through property. And so now that property prices are under structural pressure, it's going to be a real headwind, a deflationary headwind in terms of consumer spend, in terms of investment and otherwise. So that's one reason. The second reason is it's openly a communist market. They don't believe in excess profits. Excess profits are meant to be reinvested for the sake of society. So even in these innovative sectors, you saw the regulatory crackdown and e-commerce and internet related over the last few years. That's the nature of the system. That's not a glitch. That will happen again anywhere there's excess profits. And then finally, geopolitics, right? Clearly, our view is that the regions are drifting apart, and whether or not a Cold War becomes a hot war, we think that that market is going to be less and less hospitable for U.S.-based capital in particular. And frankly, you see that on this side. You see more, regulations, and you see starting with the red states, but you see pension funds and whatnot moving away from China-focused mandates. And we think that again is a structural trend and not a glitch. And so, eventually, we think that most U.S.-based capital won't be permitted to be in China. And so we're trying to go where the puck is. We're trying to go, ahead of where the puck is going.
Yeah, as Russell Napier says, it's all going to zero. But so I agree with you. But so it's sort of, for me, it's great. I just say, okay, I'm not bothering with China. I don't need. It really saves a lot of time, right? So you can just focus on other markets. Is that your view? You're just not doing anything there?
It is. Look, we say to people, we have our views in China. You may disagree. That's fine. But go get your China exposure idiosyncratically through another manager that's there on the ground, kicking the tires and understands the policy tea leaves, because that's a market more than most that's driven by policy and inflection points in that regard, as opposed to bottoms up company dynamics.
But when you speak with the big allocators, as Brent mentioned, like a Cambridge Associates, and obviously they're pseudo index players, and when they want to allocate, they're going to look at the MSCI, which obviously China's still the large percentage of the MSCI. So if those allocators go to you and they say, "Whoa, we're looking to," or any allocator looking to allocate to emerging markets, but you have no China. Like, how do you? What's your response to that?
So I won't speak to specific allocators, but in terms of the allocator community, I would say there are two buckets. There's the bucket that is very much aligned with how I described it, where they have a number of country managers, whether it's China, India, otherwise, and they like the fact that we don't do China. They like the fact that we stick to our knitting, and we have a more defined focus. And there are others that look at it the way you just described, which is basically, if I want EM, I want EM, and that includes China. It's easy to add China. You can add an ETF, you can add another manager. So it's easy to get around, but it is a conversation we have. It is a pushback that we get sometimes.
I think more and more people are keeping them separate. You can have a China portfolio and an EM portfolio. You don't need. Doesn't have to be part of EM.
Well, and we had a number of conversations a couple of years ago, and genuinely believed it, that we really thought the industry was heading towards sort of an ex-China orientation, and frankly, I think sort of what pulled the rug out from under that thesis was the DeepSeek moment, a little under a year ago, right, where suddenly everybody said, oh, maybe the AI thing in China is actually an opportunity as well. But short of that, and that's obviously what sort of turbocharged Alibaba and Tencent and the most recognizable and sort of accessible of the Chinese names. But if that moment hadn't have happened, there was this sort of steady crawl of you've got 28% of the index, that's really difficult to own, isn't performing. Jim has a statistic that he often quotes in meetings of, over a 20-year time horizon, China returned 4% with greater volatility than the rest of emerging markets. That
Lower
doesn't
returns,
sound
higher vol, exactly.
right.
The,
That doesn't. Please.
the MSCI China is below its starting point in 1994.
Right.
Yeah. It's been a tough market to make money.
The complicated thing, right, is the interconnections of all the rest of emerging markets to China, right? The more bullish on the sell side will make the argument that it's hard for the rest of EM to work without China working. And there are elements of that argument that I'm sympathetic to.
Well, one of the nice things of keeping China out is that the EM looks more like EM looked in the past. It's more cyclical, sure. It's more commodity. It's more fun to invest in. To have to worry about China is like, it's less traditional EM investing the way we knew it in the past.
We agree. Yeah. We find it a difficult market to get our heads around on either the long or the short side in terms of risk management, in terms of exploiting our long experience in the market.
Right. And we haven't talked much about India, but India is the highest growth market in a world where there's almost no growth. And it seems to be on a sustainable track. It's got tons of companies of all different sizes. It must be a great market for you to explore.
Yeah, we like India a lot. This year it's been a little bit of a holding pattern year for them, but that's the one market over time in emerging markets that actually has kept up with the U.S. So it's structurally the best performing of the large markets over the last 10 or 15 years. And we think that there are reasons for that. I mentioned earlier, we find particular value on the financial side. So we own a couple of private banks there. We don't find as much value on the consumer side, but it's a market that structurally we like a lot.
Yeah, absolutely. The evaluations in many ways they look expensive unless you're quite optimistic. Are you finding cheap stocks there?
So the valuations in the consumer sector are particularly optimistic, we think. To which we don't tend to find opportunity there. But the banks, look, there aren't that many growth financials left in the world in terms of traditional banks. We talked about a digital bank before, and their payments, and there are other subsectors which are exceptions. But Brazil, Itaú used to trade at 3.5 times book because they were growing the top line structurally in the teens. In India, it's one of the few markets, along with Indonesia and a small handful of others, where you still have that kind of growth potential, where you can still see loan growth in the mid-teens. And the Indian banks, the one we like most, trades at 1.4 times forward book, and that's interesting. We think that we're going to see a combination of nice compounding, and we're going to see multiple expansion, and so we think that's going to be a winner over time. It's going to be a multi-bagger.
It's a sector with a very long runway.
We think.
Very attractive. Yeah, there's stocks you could own. There are very few places in emerging markets where I feel you can really invest for the long term because it's too volatile. The runways are too short. But in India, you can make the case for a very long runway here, so you can be patient.
We agree.
What is your general time frame in terms of like your positioning? Are you, when you come into a position, is it all price driven, or you expect to hold it for several years, or how do you think about that?
So there are some names we've held since inception, 4+ years ago. And there are some names that were either they work or they don't.
To interrupt that bank.
That bank, the Indian bank that I referred to, we've owned since inception. But Brent and I, we're at a large shop and have good data around that. We both had around a 40% turnover rate during our period of tenure, which means a 2.5-year holding period. And I think that's similar to how we still think about the world. On average, that's about what we'd hold a name for. The long short vehicle might be a little different, but in terms of the long only.
Yeah. The Southeast Asia is in some ways you could argue it's getting squeezed, between the U.S. and China, and it's being the opportunity that the East Asian countries had to grow through exports is maybe not nearly as good now. Do you see that as a problem for growth in general for these countries? The stock markets are reflecting something, right? They've just done terribly. Is it just because they don't fit well into this new model of the new global order?
Yeah, it's a good question. The markets we're particularly interested in and exposed in are Indonesia and the Philippines. We don't like Thailand, for example, as much. There are a number of reasons they've been held back. Part of it's part of it is that they don't have a large tech sector, and it's been a tech-driven market this year for emerging markets. Part of it is China. Now that they've been basically cut off from the U.S. market, they're exporting more aggressively across their footprint. And part of it's been idiosyncratic. In both countries, you've had a bit of a political storm over the last 12 months. So you had a new president that came in Indonesia that he's a general. He doesn't really understand the markets, and he's made some missteps in terms of communication and policy. You've had a corruption scandal, which they happen somewhat frequently in the Philippines, but you've had another bout of it. And that's held them back. But again, as bottoms up investors, we see some really good companies with really good, predictable growth opportunities that trade at really good valuations. So we get excited. And this year, that market hasn't done much, but if you look over 3 to 5 years at what some of these companies should do in terms of how they grow and how they expand their margins and their earnings, we get excited.
Yeah.
Jim, what about the Middle East? I mean, like Saudi, for example. I mean, there's been a lot of activity between the Trump administration and the UAE and Saudi. What are you looking at? Are those markets on your radar at all?
So we look at them. We've been involved off and on in Saudi, typically on the short side in Saudi. It's a market where I think we're a little bit more skeptical. We love what's happening from a societal perspective. And I think that's been not only real but surprising to the degree that it's happened. We're a bit more skeptical on the 2030 plan in terms of refocusing their economy away from petrochemicals, or rather from oil. We think that's going to be difficult for them. They haven't had a history of being particularly innovative across manufacturing and technology and other subsegments. Could they have a data center subsector? Sure. Could they? There are various Me Too industries they could do, but we think that transition is going to be very difficult for them. We own a wireless tower company that is primarily African, but has some Middle East exposure that we really like a lot. So we have some exposure bottoms up from that perspective, but it's a region that we tend to do less in.
What about Turkey? Just a place that you've had some personal experience in.
Yeah, no, I did. I lived there as well, and it's again a wonderful country that deserves better government.
I guess you answered the question.
And it'll be interesting to see. It's the same with Orban in Hungary, whether they allow there to be an election, and if they lose, will they go? It's going to be a very interesting window for both of those countries. People ask us the question often about hedging currencies and risks in that regard, and we talk about Turkey in that with that angle in mind. Like we have owned basically one name in Turkey since inception, and the reason for that is we assume that we're going to lose 25% on our currency every year. Structurally high inflation, poor policy framework. Until something changes, it's going to be a weak currency. So. That's essentially a hurdle rate that we need to think about as we think about bottoms up ideas that could fit. We found one that worked, and it was a nice winner for us. It was called Hepsiburada. It was an internet name, and what was interesting about it was, it was a IPO 2021 that went down 90% because they miscommunicated. You had the market moved away from growth. They were listed in the U.S., not in Turkey, so they didn't have a natural backstop in terms of an investor base. And what was interesting to us is the Turkish government looked and saw what had happened across emerging markets and where the Chinese internet names were dominating, and they said, we don't want that to happen in Turkey. So they basically changed the rules to hobble the player that was owned by Alibaba to the benefit of Hepsiburada in particular. And they started hoovering up market share, improving profitability off a low base, and it was a very good stock. They're now being bought by Kaspi, So it's a different dynamic. We're no longer involved, but the way we think about Turkey is it's a difficult market. There could be some opportunities. There was one. We're still watching it, but right now we're not exposed.
It's a country that has all of a sudden a remarkably good fiscal position as they've been able to inflate away all their debt.
It's true. They don't have any reserves, but their fiscal situation's okay.
Their debt to GDP is down to 22%, which is remarkable in this world of every country being over indebted. That's pretty good. I wish Brazil could do that. If Brazil could inflate away its debt down to 22%, it'd be in great shape.
You're not wrong.
Careful what you wish for.
And do you guys look at Vietnam at all? Is that investable?
We do look at it. It is investable. Interesting. I think it's going to be, added to the indices reasonably soon over the next year or two. And so I think that's a market you'll hear more about. It's difficult. It's more difficult bottoms up, as we described, where they're the better names you typically have to pay a premium for, and you have to buy them on swap. And so it's a bit complicated still. But yes, it's a market that's worth paying attention to for us and for all of us.
Yeah. We haven't mentioned the big tech countries, Korea and Taiwan. Are they on your map? Do you look at those carefully?
I would say we tend to be structurally less involved in Taiwan for some of the same reasons that wrap into the China conversation. That if we're right that the economy in China is going to remain challenged for a long period of time, that the risks that the nationalistic drums get beaten in order to shore up demand or support are high, and Taiwan's going to remain in the spotlight in that regard. But we do like Korea a lot, and that's a market we've had nice exposure to, primarily through financials, through one of the historic banks. But we do like that market a lot. We think that the value up initiatives and governance focus is real. They've seen what's happened to Japan in particular, but other countries that have embarked on a structural reform in that regard, and we think that they're serious about it. So we like that market a lot.
Guys, this has been great. Thank you. I know we've taken up a lot of your time, but it's been awesome going around the world and like my map So listen, man, I want to thank you guys very much. I wish you all both the best of luck. I know things are going to be. You're in the right sector, and that tsunami wave of EM money's coming your way. So again, John, I thank you very much for coming on.
Yeah,
well, thanks for having us. It's always a pleasure to see both of you.
All right, guys.
It's a pleasure. Thank you, guys.
Congratulations, guys.
Cheers. Thanks.